We now begin with our discussion on Applied Corporate Finance Unit 4, which is basically going to talk about the capital structure. Primarily, capital structure would talk about how much of the firm's money is raised via debt versus how much of it is via equity, right? And this is going to be a major discussion point around what is a good capital structure. So at the end of this unit, we should be able to understand whether a firm is working at what is an optimal ratio of debt versus equity and whether there is an optimal ratio of debt versus equity. We're going to use live examples of some companies as we go around discussing this in more detail and try and look at how do we interpret the debt equity ratio of companies from a capital structure and cost of capital viewpoint, right? Now, we're going to cover a variety of things in this. We're going to look at what are the types of financings available, what are typical financing behaviors depending on what life cycle stage the business is in, process of raising capital, the trade-off of debt, which is essentially what are the uses, positives and negatives when a company decides to raise debt, optimal capital structure, and various approaches to arrive at this optimal capital structure. The last two are going to take bulk of our time essentially, right? So let's understand initially in terms of our principles as to we are now looking at the financing decision. We have already looked at the investment decision. Within the financing decision that will maximize the value of the firm, we want to find the optimal mix of debt and equity that maximizes firm value and the right kind of debt that matches the tenor of our assets, right? So the second one we'll take later, but the first one is essentially nothing but what we're trying to do is we're going to look at what makes basically maximizes the value, or in other words, reduces or minimizes the cost of capital. Correct? That's what we are trying to look at in the context of what debt equity ratio does that, or if there is any debt equity ratio that does that, right? Now, a firm can either raise money through equity or through debt. What is the broad differentiation between the two? In the case of equity, there is no fixed payout usually, and it is also in a sense it's a residual payout. If something is left, then it is given to the equity guys, and it is considered to be costlier as compared to debt. Debt has a fixed payout and it's considered the first in preference of any kind of payout, and that's why it is less risky, considered less risky, and hence it is cheaper. So for any given firm, the cost of equity will always be greater than the cost of debt. That will always hold true, correct? And the reason it holds true is basically because the debt holders have a priority in the payment of debt. And if something goes wrong, the firm sells itself, it will first repay the debt holders, and then if something is left, that goes to the equity holders. That's why the equity guys get what is the residual claim, correct? So just summarizing, equity is residual payout, it is expensive, debt is fixed payout, it is cheaper, right? So that's the first construct that comes to us, that you could raise money using equity or debt, and then you could kind of use that in the business cycle over a period of time, and then define what is the debt and equity numbers that you see, right? Let's take a look at a few of the companies that we are discussing and try and understand what is the kind of indebtedness they work with, right? So if you look at the debt to equity number for something like Apollo Tires, right? So this is the equity number, which is 6182 crore. This is in millions, remember? So 6182 crore is the equity number. So if I was to put the equity number, that's going to be 6182, and I'm going to decide this in INR crore. 1 crore is 10 million, so 6282. And if I look at the debt number, long-term debt is 6095. And short-term debt is 7401, correct? So effectively 609 plus 740, right? That's what we are doing. So total debt comes up to 1349, correct? So effectively, if I was to look at the total capital, 6182 comes from equity, 1349 comes from debt. Total capital is 6182 plus 1349, right? And this, remember, is in crore. So that's one. You could also find that sometimes some part of the long-term borrowings. So long-term borrowings are the greater than 1 year borrowings, and short-term borrowings are the less than 1 year borrowings. Sometimes you could have a long-term borrowing, but it's payable next year, right? So it's payable on, let's say, January 2017. So when you're making the balance sheet as on March 2016, this appears as a current liability, right? Now, while this appears as a current liability, this is technically not a current liability. So a lot of the firms basically classify it in under current liability, saying that this is the current portion of long-term uh, liabilities or long-term borrowings, right? So current maturities of long-term liabilities is what comes in. Now, when you're looking at debt, it is also interesting to calculate cost of debt. And to calculate cost of debt, you have to dig deeper and find out how much of the loan is foreign currency loan and how much is domestic loan, correct? So we dig a bit deeper to try and gauge that in terms of the total loans that they have. And this is a breakup of the 609 crore only and the long-term borrowings. We find that about 100 crore or 1000 million is debentures, non-convertible debentures. So these are these are kind of bonds that are issued, and that's 100 crore. Then from banks, they have external commercial borrowings. This is foreign, right? Other foreign currency loans is foreign. IFC, and Magyar Import-Export Bank is all foreign, right? So all this is the foreign currency loan. And then there are some smaller payments, which is deferred payment credit 2, and liability on asset acquired by finance lease. That's a small number. That's 228, all added together, 23 crore essentially, right? So out of the 609 crore, nearly 100 plus 23, that's 123, is domestic. Everything else, which is going to be approximately 486 crore, is all external commercial borrowing that is available. Borrowings in foreign currency, essentially, that is available, correct? That's the contour of Apollo Tyres in terms of the debt they have. You could dig one step deeper, and if you look at some of these notes, and you continue looking at the annual report, they would also give the maturity profile of each of these. So you could dig deeper and get that information as well, right? Now, if you look at CEAT Tyres, on the other hand, these numbers, remember, are in lakhs now. Your equity component, if I convert it to crore once again, is going to be 2064 or 2065 rounded off. Your debt component is 589 and short-term borrowings is 38, right? 38.59. So let's put that as 39 and 590. So 590 plus 39, that's 629, right? So total capital is 629 plus 2065. That's with CEAT. We can also look at MRF and try and gauge what is the MRF number. So if you look at MRF data in terms of rupees crore, the equity component is almost similar to Apollo, which is 6855, and the debt component is 1485 and 885, correct? So 1485 plus 885, that will work out to 2370 crore, correct? So these guys have a bigger debt number, 2370 divided by 6885. In the previous case, we had 629 by 2065. In the previous case, Apollo Tyres, we had the number as 1349 divided by 6182. That's the debt equity ratio that we are looking at, right? So effectively, those are the numbers that we see. There is a little bit of higher indebtedness if you compare MRF as against some of the other players, right? Now, a business typically has financing choices during the course of its running the business. As the business starts, initial startup phase, most of the money is promoters' own capital, right? So it's all internal financing that has happened in the company till then. Then the company starts growing fast. That's the rapid expansion phase. And here, typically, you go outward and go to venture capital guys. In some cases, you can do a common stock issuance as well. Then the firm gets into a high growth phase, and there you typically issue IPOs, common stocks, and then some sort of convertibles where debt can be converted to equity. Once you reach mature growth, that's when bulk of your funding starts coming via debt, because now the company is established, banks know the company, so the company will be able to get reasonable rates while borrowing money, right? Subsequent to this, the company starts degrowing. Once it degrows, there is not enough requirement in terms of how much money, more money that is needed. So it ends up repaying the money that it has already raised, right? So if you were to draw a graph in terms of the time of the company, then usually it will start going up, and then at some point it will start stagnating and coming down. So if I were to put this as A, B, C, D, and E points, then A will be here, B, C, D, and then E. And that's how your choices of financing will change with respect to where you are in the business cycle broadly, right? So that's basically your financing choices which are available. How do we measure the debt to debt financing for a firm? We typically use debt to capital ratio, where capital is nothing but debt plus equity. So debt divided by debt plus equity is one ratio. We can also use debt by equity as a ratio, right? Now debt includes all long-term and short-term debt. Any kind of external interest-bearing liability is what is included in debt, right? So let's write that term. It's an external interest-bearing liability, right? So include all short-term, long-term data in this. Equity could be book value or market value, but needs to be used consistently across the spectrum of firms being analyzed. So if we use the book value like we did in our case of Apollo Tires, we did use the same book value concept in MRF and CEAT Tires. If we want to use market value, then we should be using market value across all of these. So the E value could be either market value or book value. Market value makes more sense in general, but we're okay with book value as well for now, right? Now, that brings us to the cardinal question in our discussion, which is how much debt is actually good? Now, assume a firm can borrow money at 8%, so that's the cost of debt, and its cost of equity is 12%, so that's the cost of equity, right? Should it raise any capital as debt or have 100% equity? Now we know equity cost is higher, debt cost is lower. So it might actually make sense to have a little bit of debt for sure. How much is a question. So if the answer to the first question on debt is yes, then how much should be, the debt number, and how much is too much? This we will try and answer. We don't know how much is too much debt, but we do know that at some stage the firm would exceed the capacity of raising debt, and that would create more problems in future, right? Are there any benefits of using debt in addition to this lower cost? In addition to this lower cost, are there any material benefits of using that debt? And are there any kind of costs attached to this, right? Now, to understand the first question better, which is should the firm have any capital as debt, let's actually look at the example of a firm with no debt. So that's Infosys. This is all in crore. That's the equity value. So equity value for Infosys is 57,826 crore. Debt value, there is no long-term debt and there's no short-term debt either. So debt value is 0, right? Now that looks like a very stable and less risky firm, right? But the problem is Infosys also owns cash, and that cash is available here. Cash and cash equivalents is close to 32,700 crore, right? Now, whose money is this? If there is cash lying idle, this is nothing but the equity holders' money. In other words, because there is no external debt, you can immediately repay this money to the equity holders, correct? What the company is doing is they have kept this money here, and this is practically idle money because it is going to earn basic bank rates. So the equity holders are giving us money at approximately 13% because that's what the cost of equity for Infosys would work out, 11 to 13%. But we are putting it in a bank which might be giving very meager returns. Now that doesn't make sense, right? So logically, the firm should probably raise debt and use cash for either dividend or buyback, right? That's where the cash should be utilized and be returned to the shareholders rather than holding it there in terms of a huge amount. A lot of the companies do not have any debt. It's important to understand that some debt might actually be useful. How much is good? We will look at that as we go along, right? But we understand here that Infosys is sitting on a pile of cash, which is practically the equity holders' money. It can be returned to these guys, but they choose to hold it because they want to play safer. What that does is, while they become a little bit safer in terms of financial statements, they are essentially losing money on this transaction, right? Is because they're borrowing money at 11 to 13% from the equity holders, or equity holders are basically expecting an 11 to 13% return, but the money is lying idle in a bank account, which might be at best giving a post-tax return of 3-4%, right? That's why some firms should have debt, right? So what are the key benefits and costs? While we will look at this in more detail as to what the benefits and costs are, some of the quick key benefits are lower costs in terms of having debt. You get tax benefits because interest is essentially tax deductible. You first pay the interest, and then what is the profit before tax left, you pay the tax only on that. Plus, when you raise money from external sources, there is an added component of discipline that comes in, right? Key costs include bankruptcy costs, which is the firm does not really repay the loan, right? Once you have taken the loan, you may actually go over and file for bankruptcy. Agency costs when the stockholder and the bondholder interests don't match. As a bondholder, you can give debt to the company, but as a stockholder, it might make sense to probably invest that in ultra aggressive projects, for example, right? And loss of future borrowing capacity, right? We'll look at all these in detail as we go along. That brings us to the end of this first particular video on the Unit 4. A couple of quick questions that we need to answer. How do we measure the debt financing of a firm? And what kind of funds would the firm usually raise in the initial phases, which are the startup and the rapid expansion phase of a business life cycle? Thank you.